Happy Wednesday. It is January 31st, last day of January 2024. And this is the Lifetime Real Estate Advisors podcast. Here we are, your co hosts, Dan Mullen, the CPA mortgage guy, and Brady Mullen of American Liberty Mortgage. Today, we're going to talk about something we hear all the time when we talk about renting versus owning. Sometimes we get comments on along the lines of, okay, well, Dan, well, Brady, what if I rented and invested the difference between what it costs to rent, my monthly out of pocket cost to rent versus a mortgage on that same property, for example?
Plus the down payment
Because
being invested somewhere or something like that.
yeah, and the down payment being
Yeah.
invested somewhere, like how do I do an apples to apples comparison versus, okay, I'm deciding to rent because of market conditions or personal preference or whatever, and I want to invest that money in, I don't know, the S&P 500. Won't I be wealthier by doing that? And we're going to break that down. And of course, the answer, as always, it is depends, but it's good to have some data here. And that's exactly what we're going to talk about today. So, Brady, do you want to talk about some of the thoughts that you have on that and what drove us to create, a spreadsheet doing that? Our big thing is helping people understand the financial impact of their real estate decisions. And this is a potential decision out there, right?
Yeah, so we'll run through these calculations. And I like to point out too that you and I didn't start out in the mortgage and real estate industry.
Right.
You're an accountant. I was a financial advisor for 18 years. I sold my practice, retired from that. And the reason I did that is I wanted to help people understand the nuances of real estate. So I wasn't born and raised in real estate, neither were you. Uh, we came to the conclusion that these are the most important financial decisions people make, for better or for worse, right? It's such a big lever that making the wrong choice about real estate could be disastrous, but it could also be the best decision you ever made.
And similar to you, I noticed when I was helping out my clients on the CPA side, I would notice that the difference between those who were struggling and those who were comfortable and even wealthy was almost always real estate. And so, I mean, similar sentiments, they kind of brought us together in this strange way, coming from ancillary financial industries. They led us to real estate.
Yeah. So let's run these calculations. And I like my whole passion is to bring the tools of the financial industry into real estate because that generally isn't done. Most financial advisors don't talk much about real estate. And so I like to do that. I feel almost compelled to do it. So
Most
here's
real
the
estate agents and loan officers can't speak to that as well necessarily. We would love to change that. We would love to educate agents and loan officers on how to do this. I think it would elevate their status and their trust in the community and put them at that same table as their CPA, their financial advisor, attorneys, those kinds of things. That's our goal.
Yeah, I mean, if you're now, not every real estate agent and not every lender deserves a spot as somebody's trusted advisor, right? You have to earn that. But a good real estate agent and a good lender, they are as valuable to somebody as just about any other advisor there is because those levers are so big and making the right or wrong choices about real estate matter so much. The problem is it's just not always about buying real estate, which is what some people are going to want to say, or et cetera. Like it's a nuanced issue. So the way I like to discuss it first, just high level before we get into the calculations, is just the whole idea. Because I've just recently, it seems there's been this surge of interest in forever renting, people that want to rent forever and justifying that with numbers and seeing how that makes sense. And it's kind of compelling. And I'll show you what I mean. I've even heard this from financial people that I respect very much. Like you'll see, this is Ramit Sethi on the left, Morgan Housel at the top, Grant Cardone on the right, and these are people that I respect from a business sense. Morgan Housel and Ramit Sethi are amazing personal finance people, and I've heard interviews recently with both of them where they're saying like, "Well, buying a home isn't a really good investment." And ironically, Morgan Housel recently purchased a home with his wife and kids, and his reasoning was, "Well, I just wanted a home that had I wanted all my walls without any neighbors." And I thought to myself, if you're really thinking that renting is better than owning, you could rent a house, right? Like clearly something you felt differently about that. But the sad thing is, I really respect those guys very much. That doesn't mean they get everything right all the time, but they're getting this one wrong, and I'll show you the numbers in a second.
And what I find interesting about that too, with Morgan Housel in particular, yeah, he bought a home just against his better financial judgment. Buying homes isn't always about the finance. Like that's, in fact, it's usually not. Unless you're investing in properties, it is something. I want to stop sharing a wall with somebody, or a ceiling, or a floor, or I want to plant a garden, or I want to paint the walls, whatever the crap I want to paint them, whatever color I want to renovate bathrooms. I can't do that when I'm renting. His reasons were non-financial, but still, like the purpose of what we're trying to do is to also incorporate the financial impact of all these decisions. And I find it interesting that his reasons were non-financial and they're still relevant.
Yeah, is he's just getting the financial part of it wrong. And so I always like to say if somebody makes that claim, ask to see the math, show the math. Because in all the interviews that I saw where these three people are saying, "Oh, you don't want to buy a home, it's not a good investment," I never saw any math. And you even see articles in the New York Times and the Wall Street Journal recently about this same idea. And again, show me the math and then let me make a decision because they're saying don't buy a home, it's not a good investment. But let's look at the math. And I also think
Yeah.
one of the reasons they get this wrong so often is because they're in finance, and real estate and finance have some crucial differences.
Yeah, I did want to say that sometimes, like in articles, it's a lot easier to show the math. If you're doing an interview face to face, and we don't have a computer and YouTube like we have right now, it can be harder to show the math, right? Because just talking about it, it's hard to do that because 75% of our population are visual people, and so sometimes I understand why they don't. But if you're going to make that kind of claim, you want to back it up somewhere and point to that source.
Yeah,
So here we
because you're
go,
talking
doing just
about
that.
yeah, you're talking about huge numbers here that have a huge effect on people's lives. So let's just
Six
jump
and
in.
seven figure impacts. Yeah.
Yeah. So let's talk about we're talking about a $500,000 home. Now I know there's no way that we can do one example that's going to apply to everybody across the country. So we're doing this for a home. I built this because I live in Denver, so it's reasonable for a modest home in Denver. But it doesn't really matter. It's the shapes, and the truth is we should be running calculations on individual situations when you're thinking about making this decision. So this is just one example. If you buy a $500,000 home and you put $25,000 down, which is 5%, that's money that goes out of pocket. That's a cost. Then there's a $4,800 cost in this example of closing costs. I'm not including tax and insurance on the closing costs because I include those in the PITI throughout the year. So that's 42,000 in principal, interest, tax, and insurance. So that's your mortgage payment multiplied by 12 for the following year. And then I'm assuming some budget for maintenance. Now that could be low or high depending on the age and quality of the home. And these are variables that we can tinker with to show the projections. But this is the example that I'm using, and it's pretty reasonable. So those numbers added up together are $74,000. Now it doesn't cost $74,000 to own this home every year because 30,000 about of that cost was the down payment and the closing cost, which doesn't need to get paid every year. It's just once. But if you look at that, you would expect at the end of one year to have something to show for that investment. So that's what the financial people are thinking. If I invested $74,000, what do I have a year later to show for it? And if I got 4.5% appreciation on this $500,000 property, and I started with $25,000 of equity only, the rest of this was just went out the door, except this P in the PITI, that stands for principal, as you know, that is chipping away at the principal. So that's adding a little bit to my wealth in the form of paying down the mortgage. So how much equity do I have
That-
one year later if the property appreciated by 4.5%? Only 50, I'm going to call that $53,000. So any financial person is going to look at this and say, I invested 74, I ended up with 53. What's my rate of return on that? Well, it's about negative 29%. Now, for any financial geeks out there, I'm cheating a little bit because I'm assuming that all of this PITI was put into this $74,000 right in the beginning, but it actually went out over 12 months. So this is actually a conservative way of looking at this, showing that I was out all that money right in the beginning. But this is just napkin math. Then we'll get into the more serious math in a second. So this looks like bad. This does look like a bad investment. Why would I put 74,000 into something only to have 53,000 worth of value one year later? That's a bad investment. So here's what everybody's missing. Here's the key. I didn't invest $74,000 into that house. So if that block represents the first year cost of owning that home, including the purchase cost, down payment, and closing costs, you have to remember that I was going to spend $36,000 on rent that year in this example.
Yep.
Right. So I'm talking about a home that rents for about 2,900, 2,950, and rather than that, purchasing the house for $500,000. Again, this is one example, but we can run numbers on any example. That's the tool that we use. So I really didn't invest 74 because I was going to spend 36. I was going to give that to a landlord anyway. So what you really have to think about, the only money I really invested in home ownership is the amount above and beyond what I was going to spend in rent. That's the amount that I invested in owning this home because I was going to
Bingo.
spend this anyway, and it was going to go out the door. So now that rate of return goes from negative 29% to 39% positive.
Yeah, and that investment number too, we're not going to get down to the math exactly there, but I mean, you can do it if you want to on your own. Pause the video if you wish, but essentially, you're turning $37,843 of wealth into $52,684 worth of wealth in that first year. Again, that first year is your worst year. Number one, because the interest portion of your mortgage payment is the highest it will ever be, assuming you don't refinance. And so, like, even so, yeah, that turning that 37.8 into 52.6. If you want to do the math on your own, great, but that's a rate of return of 39.2%. Much different than, yeah, that's the factor that the others don't consider. The opportunity cost of, hey, you have to live somewhere, you want to live inside, you're renting or you're owning this place. Yeah, you have to factor in what you didn't spend on rent.
Exactly. Because the bottom line is it just costs money to put a roof over your head. And most of us have one of two options. You can either rent it or you can own it. And so this is what you have to consider as the money that was laid out for home ownership, not the total. Because the total was
Yes.
half of it, about, again, every situation is different, but in this example, about half of it was going to get spent, was going to be given away to the landlord, and we don't have to do that anymore. So it's only the extra that we can consider as money that was invested into real estate that wouldn't have otherwise been spent.
Right.
Um,
So, any
Go
other
ahead.
thoughts on this before we move into the idea of should I rent and invest the difference? What would happen if I rented and invested the difference in the S&P 500 or the stock market, whatever, versus buying a home instead? What's my return? How is my wealth going to grow in home equity and in appreciation and debt
Sure.
pay down? How's my debt? How's that going to increase my return? And how do we compare those?
Let's jump into that math, but before we do that, I want to mention that a lot of times people will say, "Yeah, but you're not factoring in the cost. If I want to actualize this wealth and turn it into money, if I wanted to spend that equity, I'd have to sell it, and then there'd be some fees to the real estate agent," and that's true.
Sure.
Which is why I'm just showing the first year. If you think you're leaving in a year, it's pretty risky to buy a house. You're hoping
Yeah.
for like a 10% appreciation in your market, which is not a reasonable thing to expect. I'm only using 4.5% here, but I'm just saying if you really want to cash in on a home that you bought to live in, and I'm not talking about flipping a property or making some major upgrades. I'm talking about if you just think it's going to appreciate a lot, so you buy it intending to sell it later. A year is too short of a time frame. That's just a gamble in that period of time. So in the
Definitely.
in the next calculation that I'll show, I do show the cost of selling it because most people don't stay in the home they purchase their first time, right?
We have to also understand what's baked into this assumption in the principal, interest, taxes, and insurance. What is our mortgage rate on that? What do you have in there? Because that does
Six and
matter.
seven eighths.
6 and 7/8. Okay, so that's roughly the national average. What it is as of today. If I look at Mortgage News Daily, yeah, that's pretty dang close. So
Yeah, that's doable. And rates are
yeah,
going to bounce around. And if somebody's watching this and thinking, well, yeah, but what about this variable, or what if this, or what if that? Let's throw that in the calculator and see what happens. Stress test the thing. I'm just using an example that's reasonable, and we can show an exciting example where appreciation is a lot more, or we can show a worst case scenario where appreciation dives for some reason. But yeah, so my point here isn't that everybody should always own a home and there's no risk in doing that. My point is, like, the longer time frame you're expecting, the more reasonable you can expect an appreciation on the asset. And if you're not on board with that, if you think that, well, I really don't think I really don't think these houses around me are going to cost more 5 years from now than they do today, or 10 years from now, then my answer to that would be, then don't buy a house, right? If you really think that real estate is going to crumble and people aren't going to want those homes 10 years in the future, then don't buy one. That's a bad investment. I just can't believe that.
well, one of the things I hear some people say too, and it rings true to a point, but it's also very boring, is the way to maximize your real estate equity, your real estate wealth, is to move as few times as possible. Now, to me, that sounds boring. I mean, I'm in my second home right now. Our first starter home, we outgrew it. I mean, we happened to buy in July of 2020, which happened to be a good time to buy for whatever reason. But during COVID, my walls felt really close together because everybody was home all the time. There was noise. But I mean, I could not stay in that home for longer, because my family grew. I had more kids. I had different needs. I could afford more. I wanted to upgrade my lifestyle too. But there's transaction costs in there. But also, you're as you upgrade, maybe in a larger home, that home might appreciate more just by dollar amount. versus that. But assuming that, that's also very boring. People move, they get jobs, they want different lifestyles, they get bored with their homes, they want to live somewhere else, they want bigger yards or whatever it is. But all things considered, yeah, I mean, moving does happen. There are transaction costs to that, and we got to consider those.
Well, another thing to point out that you reminded me of is uh, sometimes people will think something to the effect of if I buy this house and I if I were to live in less and invest the difference, would that be better? And the answer is yes. Like technically speaking, if you just want to talk finance, if your only goal in life is to die with the biggest net worth, then living in a tent would be the best way to go, and investing everything in real estate stocks or whatever it is you want to invest in. Living in it, like lowering your living expenses, would be the best. And this is really popular. There's a lot of people now doing the house hacking, which I think is a great, if you're single, or I mean, you don't have to be single to do it, but if you've got an appetite for house hacking, like you don't have kids in the home and it works for you, that's a great way to lower your expenses. And the lower your expenses are, the more you can invest in other things. That's fantastic. So I'm not talking
Time.
what we just talked about in those boxes that are moving around. That doesn't scale forever because I only get to subtract the money that I would have spent renting. So I can't say that if I'm renting a house for my family and it cost me $3,000 a month, I'd be better off buying a $50 million home. That doesn't add up because I'm subtracting such a negligible amount from the amount that was invested in real estate. That would not be a good investment. But you have to think of it in terms of, where do I want to live? What standard of living is I don't want to say my minimum standard of living because it's not really about survival, but how do I want to live? And does it make sense to own that roof over my head or to rent it? And once you make that decision, then we can play the finance part, because the finance part is objective. The other part that we just talked about is subjective, and people just have to make that choice for themselves. So if you're renting a place for $2,000 a month, then you might want to buy something less expensive than a $500,000 home, because depending on the market you're in, that might just be more appropriate for the numbers we're talking about.
Yeah, and we can, I mean, we could do, there's so many variables to this too. Oh, well, a starter market in my demographic or in my geography is 200,000. You're talking about 500,000. Well, maybe if you're downtown Los Angeles or New York City or something like that, a high cost of living, all these numbers are going to change, and we can modify what we have with our spreadsheets and our scenarios as we want to. But I mean, we're trying to appeal to the masses. We're trying to use averages, and there's only so much we can do in a 20 to 40-minute podcast. So
Yeah, and
anyway.
sorry, go ahead.
No, that's it. That's yeah, there's only so much we can do, and we can do these by appointment too. You can pop us an email or call us, whatever. If you want to narrow that down to individual situations and work with the people we work with to help you understand that, that's we love doing that.
Yeah, and I just wanted to add to what you were saying. I don't know if appealing to the masses is what I would consider myself trying to do. I think of it more like I want people to open their eyes and just do the math, because you may very well run the numbers and think to yourself, okay, based on my market, based on my time horizon, I really shouldn't buy. And if that's the choice that you make with the information in front of you, then that's the right choice. And I'm
100%.
not arrogant enough to say I know what you should do. What I want to do is provide the data so that you can make that choice.
Yeah. Yep, exactly. And sometimes the appropriate choice is to rent sometimes. We're not going to say renting is evil or morally incorrect, right? That's not the argument. It's like we want to give you a clear understanding of the financial impact of your real estate decisions. You've heard me say that several times before.
Yeah, and
That's
when
true. That's
people
our
say,
goal.
well, yeah, when people say, "Well, I like this apartment complex," or "I like this thing," or "I like living in this part of town," "I like living with these kinds of people around," and you can't put a price on that, I want to hesitate and say, "Yeah, we can." And once we put a price on it, then when you make a decision, you're making it more informed. So if we do put a price on it and you see what it's actually costing you and you still continue to do it, then that's the right decision, and I wouldn't judge that. But not knowing the numbers isn't a good, just sticking your head in the sand and not looking at them is probably not the right approach.
Yep, and it's all about h- helping you make the right decision. Not only that, but being helping you be confident in making the right decision, right? Because that matters a
Yeah.
lot. Like if you go in there and you're cold feet and you feel like you've been sold a financial cage by whoever is helping you buy real estate, I mean, we're not here for that, right? That's not what we're here for. We're just to help you give solid information to help you make a good decision based on financial reasons. Because we know that, again, most people buy homes, especially the ones they're going to live in, based on non-financial reasons. That's why they might consider looking for the home, but then they turn around and say, no, I don't want to do that for financial reasons. Usually financial reasons are the reason they say no. So if we can provide a clear picture on that, that's what we're living for here. So
Perfect. So this is if you saw the last podcast episode, this is the tool that we use to compare what's going on with your wealth when you rent versus own. And again, I'm very careful to distinguish between wealth and money. Those are different things. Wealth is more comprehensive, but these are the variables.
yes.
I won't go through them one by one in this podcast because we did this in the last one. But there's, there's the variables for renting. Here's the variables for home ownership and purchasing a home. These are the assumptions that I'm using: rent increase at 3.5%, home appreciation at 4.5%, and inflation at 3.5%. And this spreadsheet has all sorts of data that populates what I call this the dashboard. There's all sorts of data that populates this. A lot of it's on this page. And this is one that I have that I like because it shows the comparison of if I'd invested that extra cash that I was going to invest in a home in some other investment and it earned X rate of return, how much better or worse off would I be financially over a certain period of time? And I want to answer that question.
Yep.
So let's see. So this shows first of all, the comparison rate that I'm using is this variable here. I'm just using 10%. So what we're looking at is if I buy a home, these are my costs to do so. So I'm going to spend almost $30,000 with down payment and closing costs and an extra $734 in the first month. So I'm out of pocket $30,534. Had I invested that in a Roth IRA, I'm saying Roth IRA because I'm showing no tax drag on the returns here.
So I think it's also, yeah, this is good, but I want to kind of preface this with the metrics we're using. Again, we're using a 7 7/8 interest rate. We're using 5% down
Six
on
and
a
seven eighths.
$500,000 home. Sorry?
6 and 7/8.
6 and 7/8, excuse me. Yeah, right. Okay. Well, I mean, we could change it to whatever we want, depending on what the market is at the current day. We don't know what that is in the future, of course. But
Yeah.
yeah, those are our metrics: 6 and 7/8, 5% down, $500,000 house.
Yep. So this data is coming from these variables here, by the way. So you
Oh
can
yeah, and the
pause
rent
this and
is renting for 2950, which is, I mean, in Denver, Colorado, and in Salt Lake downtown, Metro Salt Lake, that's pretty reasonable for a 3-bedroom, 2-bathroom house that would cost around $500,000.
Yeah. So here you go. So this is as if the money were invested in a Roth IRA with no tax drag, and it earns this rate of return, 10%, every month. So it's an annualized 10%. So it's 1/12 of that every month. Plus, I'm adding into this investment pool the difference of how much I saved by renting versus owning. And then at the end, so I'm gonna zero this one out for just a second to show you what I
You
mean.
want to zoom in too? Those are pretty
Oh,
small. I think if
yeah,
people
thank
are
you.
watching this, we give it a zoom. Yeah, okay. That's better.
All right. So this is the money that I've spent on home ownership. This is the equity that I have at the end of that first year, minus
Okay.
this 734, because that's also a part of this 12th month cash flow exchange. So so I've got $53,000 of equity in this home, and I've put into it, the total of these figures. That's a 41% annualized rate of return, assuming that it appreciates by 4.5%. I don't know that it's going to do that, and hoping for it to happen in any given single year is kind of a risky proposition. If you project it out over a decade or two, then you can assume an appreciation in real estate. But over 1 year, that's a pretty risky thing. Now, if I have to sell it at this time, and I have to pay 6% in fees to get rid of it, with a real estate broker or whatever, then that's going to bite into my equity there quite a bit, and I'm only going to walk away
Sure.
with 21,000, and having invested quite a bit more than that, my internal rate of return is pretty ugly.
Yeah.
That's why you don't want to buy a home if you know you're going to be selling it in 1 year, unless you're flipping it, right? You're taking something way under value and adding value, but that's not what most people mean when they're thinking of buying versus renting. Although that's
Right.
another strategy we can explore. Somebody might also say, well, it's cost more than just the realtor fees to get rid of it. It costs, then maybe there's some concessions, maybe there's some other expenses. Okay, let's raise that up to 8. Now our internal rate of return is even worse. We put in quite a bit. We only took out. So 1 year is a risky proposition.
Definitely.
Let's go over 2 years. What does that look like? Still not great. Had I invested the money into the Roth IRA, I'd have $54,000 if it was earning 10% versus the 38 in home ownership,
Could you
which was a
clarify what you mean by invested the money in a Roth IRA? You're talking about the cash difference between the rent payment and the mortgage payment?
in addition to the down payment and closing costs.
Okay, very good.
So yeah, this year two here is showing all the money that I spent on my home that was more than what I would have spent in renting and investing that somewhere else and earning 10%. By the end of 24 months, I'd have $54,000 if I sold the house. Now, if I was just living in the house, I would have $81,000 equity, assuming that it appreciated by 4.5%. So that would clearly be a much better rate of return. But if I needed to move in that period of time and it was going to cost me 8% to leave, then my rate of return, I put more money into this home than I'm going to take out of it compared to
Sure.
what I did
But
renting.
but I wanted to clarify too that in the blue column you're talking about, a column on the right, they're investing like a renter, let's say, because the difference is there. I'm paying in this case $645 less to rent. I'm investing that into this Roth IRA. That is also included in the rate of return plus the rate of return of 10%, which is for many financial advisors, it could be aggressive, you know, maybe not for if you just dumped it into straight something that tracks the S&P 500, but 10% is a healthy return. So we're still kind of trying to stack the deck in favor of renting and seeing what happens.
Sure. And we can move that to 12 and see what that looks like in a bit. Yeah.
Sure.
So what I'm showing here is the money that I spent on a home that went into my Roth IRA and it earned 10%, a twelfth of 10%, because these are monthly figures. So it earned an annualized 12% over 1 month period. And I added 734 to this. So you can see this is up about $1,000 from the previous month because I earned 10% on what was already there. And I added 734 because that's how much I saved by renting instead of owning. So again,
Right.
if I needed to sell the house 2 years later and it only appreciated by 4.5% per year, I'll take some money. I'm not going to walk away with nothing or have to bring money to the closing table, but I'm walking away with less than I put into it. So I'm
Yep.
walking away with 38,000, whereas I would have had $54,000 had I stayed renting and put that somewhere else over a 2 year period.
Right.
Over 3 years, we're getting pretty close. Now my internal rate of return, assuming that it cost me 8% to sell at that time, I've now got $65,000 versus 67 is pretty comparable.
Catching up.
Yep. And then let's go down to now this is the fourth year. After 48 months, I sell it and walk away with $95,000. That's a 16.3% annualized rate of return or internal rate of return compared to if I got 10 on my Roth, I'm about $20,000 ahead or $18,000 ahead.
And you're still baking in that 8% cost of sales, which could be less, it could be more, depending on, you know, what you need to do to prepare the home to be sold, if there's any upgrades in there,
Good
if
point.
there's closing costs and realtor fees. Yeah.
So remember though, however, I am including a maintenance cost in the cost of home ownership. So this negative,
Right.
this amount that it costs more to own a home than to rent, I've baked into that a cost of maintenance. And we can raise that or lower that to another variable we can tinker with to see if owning or renting makes sense for somebody. So by the end of 4 years, you're pretty, and 4.5% appreciation is not unheard of. It's not crazy. It's not a lot. It's not a little. But we can change that to 3 and see how those numbers change. Like we can tinker with all these figures. But I think it's a pretty, and the longer we go out over a longer period of time, 3, 4, 5 years, the more reliable a decent rate of return is going to be. In any given year, just about anything can happen. You know, COVID,
Right.
Russia invading Ukraine, any kind of global news could change any local real estate market for better or for worse. But the longer you go, the more those things seem to temper out. So the next one, we'll go into 5 years, and then we'll skip to 20, or we'll just look at both at the same time. I've got the 6 through 19 also, but I just hid those so we don't have to go through each one. But after 5 years, you're looking at an 18.7 internal rate of return on the extra money that you invested in home ownership. Even if you and this is again including if you sold it and paid 8% in the process to sell it. Whereas your internal rate of return on if you're getting 10% return on all that money, you've got 88. Now let's go out to
And
20 years. Go ahead.
there could be also there could be a cost to moving out of renting. If I know landlords are sometimes, and I'm not going to paint a super broad brush here, but sometimes landlords can be like, you know what, your security deposit is mine, because I don't know, I see a scratch on the floor or something, or you left a nail hole in the wall where you put your picture up. I mean, it's not a zero. It may not be significant, of course, but I mean, so there's cost to moving and renting as well.
Sure. I mean, the cost of moving with home ownership is clearly significantly more because it's not 8%
Yes.
of your equity, it's 8% of the value of the property. And by year 5, it might be it might be worth $600,000 or something, and 8% of that's going to be $48,000. Like it's a substantial expense to be aware of, which is why, again, I don't think buying a home intending to sell it a year from now is a smart thing to do. It's risky, I
Great.
should say. It could play out very well to your favor. If we hit another 2020 or 2021 where we've got crazy appreciation, then that will work out for you. But I would never recommend relying on that to happen. Now
Trying
look
to
what
time the
happened.
market, any market, including the real estate market, is a fool's errand, really.
Amen. Amen to that. So in year 20, now I'm going out into year 20. Now you'll notice that the amount that you're saving by renting starts to shrink, right? Because the cost of renting is increasing over time. The cost of home ownership is significantly more flat. It's not completely flat because of tax, insurance, maintenance, and things like that, but it's significantly more flat. So by the time, if I'm going to let you invest this difference into your Roth IRA, then I'm going to make up for that when it becomes positive for me as a home. I say me because I'm a homeowner, I guess, but I'm going to make it positive for the homeowner when there's savings for home ownership, that must be paid for out of somewhere. So that becomes a negative number. So rather than adding this number plus the rate of return for this figure here, I'm now subtracting this number. I'm still giving the 10% rate of return on everything that exists there, but I'm subtracting $7 a month because that's the difference. That's what it costs extra to rent than to own. So if we're going to play that game, we got to play it on both sides. And that starts to grow pretty quickly, where now it's a few $100s a month. And by the time we get down to I don't know what year this is. I'd have to look over on the left. We're looking, well, here's the end. This is year 20. Well, by year 20, it's costing you $1,771 less to own a property than to rent. And that's more than the interest that you're earning on your 10% annual return on your $176,000 Roth IRA. Now, I know
Well,
that you wouldn't take that money out of your Roth IRA to pay the mortgage, but if we're gonna let you add that when you're renting and that costs less, then we have to subtract it when it costs more to rent. So that's the fair way to do that. So it doesn't even keep up with the interest that you're making. You see how this amount starts to decline because it costs significantly more to rent at that time. Whereas if you're saving this money from home ownership, you don't have to deal with that. That becomes the equivalent of getting cash in your budget by saving it because you're owning a home. And your rate of return or your internal rate of return, if you were to sell it 20 years later, would be 15.6%. Like look at that number, 840,000 or 841 versus 173. Like I'll take that. Thank you very much.
And you haven't even paid your mortgage off for
Now,
20 years.
yeah, correct.
So one more question I have here too is the effective private mortgage insurance. Have we accounted for that?
Definitely. So check this out.
Yes.
Sorry?
No, so we are accounting for private mortgage insurance. Tell us
Yeah.
about those metrics, because that's a big discussion. People are saying, hey, there's a lot of people out there, the Dave Ramsey types. I respect Dave Ramsey for a lot of things. I think he's wrong about real estate sometimes, but he's like, never buy a home that you have to pay private mortgage insurance. Terrible investment. How do we account for that here?
Well, here it's just this figure. So in this assumption, I'm showing $158 a month in private mortgage insurance, and I'm showing that it lasts for 3 years. So we could show
Why
that it
only
lasts.
3 years?
What?
Why only 3 years?
It's just an assumption. We can put 4 in there. We can put 5 in there. And everything will adjust for that. And so let's go back to this IRR comparison. You'll see, if you remember, I think this was 15.6 when we had it as, let's go back to 3, go back to the internal rate of return. Yeah, it's 15.6 if your private mortgage insurance lasts for 3 years. If it lasts for 5 years, then it's 15.3. Like clearly it's better. All things equal, it would be better not to pay mortgage insurance. But if it means I have to save up 20% to put money down and that costs me an extra 4 years of renting or something like that, that's not smart math. Like you need to get on the train, as we say a lot in the industry. Like if you want the best house that you can possibly get, the best way to get it is to buy the house you can afford as soon as you can and use that equity. Go into it 5 years later. Let's look at this number again. 5 years later, you've got, oh, come on. Yeah, so this is at the end of 5 years. If you sell it and walk away, you've got $126,000 of equity to put into the next house versus the $92,000 that you might have saved had you been disciplined with the money. I mean, and also, frankly, like who calculates how much they're saving by renting instead of home owning?
Yeah. And
And
that's
safety.
exactly that amount. It's funny.
You can't
I
even.
actually recommend doing that. If someone is a first-time home buyer, for example, and they're on the fence. They don't know if they can afford a payment that would cost to own a starter home or whatever. I often make the suggestion, okay, well, what is your rent right now, and versus how here's your. I mean, we calculate their mortgage payment for them. Obviously, that's part of our job. What is the mortgage payment? What is the rent? What's the difference? Let's say for easy math, let's say it costs them $1,500 to rent and $2,000 for the mortgage payment. I often recommend, okay, spend your $1,500. Obviously, pay your rent check. You got to still live there, but then save an extra $500 to see if you can afford that $2,000 monthly payment, because that'll give you a good thermometer for, yeah, I can do this, or no, I can't. If you can, great, you're in a good position to own that home. If you struggle to save that extra $500, maybe you're not ready yet, and that's okay.
Good point. So here, a couple of changes we can make that I know people want to see is like, well, what if my maintenance costs are higher?
Sure.
So what if my maintenance costs are higher? How does that change my rate of return? It changes it a little, right? Those are extra expenses for home ownership. Changes it a
Sure.
little. What if we those? By the way,
You're
those
already
were
turning over at 4 though, and you kept private mortgage insurance on for 5 years. So, I mean, yeah, there's the
that's
math,
true.
guys.
So then here, what another one that people might be anxious about is something like, what was the one I was thinking? Oh,
HOA
what if
maybe?
my home doesn't appreciate by 4.5%?
Oh, sure.
Morgan Housel said this in his interview on the Diary of a CEO podcast. He said, you know, what a lot of people don't realize is that homes, when adjusted for inflation, barely appreciate much. And it's like, okay, but you have to remember, what's my other option? Unless I want to sleep outdoors, my other option is to give the landlord a bunch of money. So that's what I'm trying to compare, not the overall money that was spent on shelter and what do I have to show for it, right? Because we have to solve that problem. So let's put the appreciation down to 3.5%. So it's the exact same as inflation and rent increase that we're showing here.
Sure.
Now we'll go back to the IRR comparison, and it's going to look worse because I'm showing less appreciation. So by 5 years, I'm fairly close to the money that I would have had in my Roth IRA. And by the way, this is another kind of silly thing because you can't put this much money into your Roth IRA every year, but at
Right.
least not today. But anyway, you're still, I mean, if those are the cases, I wouldn't call this a worst case scenario, but I'd call it a very conservative scenario. You're still, after 5 years, you're starting to break even. And still after 20, you're talking about, massive differences.
Yeah.
646 versus 360. That's meaningful.
Yeah. Nearly double.
Yeah,
And I mean, there's so many variables here we're not talking about, like tax benefits on a mortgage.
absolutely.
Like you get a 1098 at the year. Not everybody qualifies for that because the standard deduction is higher. But I mean, there's all kinds of things in here and benefits that we don't have time to talk about because that's minutia. That is just, I mean, maybe overwhelming again for a 20 to 40-minute podcast. But yeah, there's so many more benefits to home ownership, and that's the reason we kind of made significant moves from our financial background industries into real estate, is realizing these things.
Yeah, and that's just the tip of the iceberg. There's all sorts of other issues, things like investing in real estate. There's another area on that spreadsheet where if somebody wants to house hack, we can show income coming in from rooms that they're renting out, or if it's a duplex from another unit in the property. So we
Sure.
haven't even talked about that, but that's a great way for, again, as we talked earlier, for single people or people who are willing to have roommates. That's a great way to lower the cost of living when you're in a phase of your life where you're willing to do that.
That'll be a great subject for a future podcast here in the near future. I love house hacking. It's a great way to get started in investing. One thing I love about that too is it gets somebody in the mindset of investing. So like they're used to that. They understand the returns are awesome. That drastically reduces their cost of home ownership. And they move out, they keep the property, they keep the investment. Now they're investing in properties with super low interest rates comparative to, I mean, this is an entirely new subject that we'll go into detail on the next podcast, but I'm excited to talk about that one. It's a great way to get into home ownership and invest at the same time.
Yeah, totally. Totally agree. Um, Yeah, that would be fun. Let's do the house hacking one soon. I like that.
All right. Well, that wraps it up for today's episode. Thanks for tuning in. If you need to contact us, you can email me at thecpamortgageguy@gmail.com. How do we contact you, Brady?
You can email me at brady@ltrea.com. That's Lifetime Real Estate Advisors. Brady at LTREA. Reach me that way if you want.
Okay. Well, have a good one. Until next time.
Thanks, Dan. See ya.